So I want to make this video to show you exactly how money is made trading Forex and to make it simple for you.
Yeah, let's do it. I'm pumped.
So to get right into it, the first thing you have to know when it comes to making money in Forex is to know what is a pip. The pip is just like a point for stock investing. So every pip is your differential metric for profit or loss. So a pip is basically, your price interest point. And on a pip, how to measure it is, there's pairs in Forex. So you got Euro USD. If I go over here, you got Canadian JPY, you got Euro AUD here. So a pip on a non-Japanese yen pair, like for example, Euro USD, a pip is the fourth decimal point. So, if we use this price example, $1, 1.1234, the 4 would be the pip value in this example. In a Japanese yen pair, a pip is the second decimal point because 100 yen is similar to $1. 1 yen is like a cent because the yen doesn't have like cents. It's just a dollar value, and they just move their dollar value 2 decimals up. So 100 yen is like $1. So for this example, the yen, the second decimal point is a pip. So if we look at 100.23, the 3 would be the pip value. The second thing you need to know is the lot size, which is the size of the trade. So there's multiple ways to, quantify a lot size. So just to make it simple, we're just going to go by decimal points. So if you look here, the smallest trade is a 0.01 lot size known as a mini lot. The next decimal form up is the 0.1, which is a micro lot. And the last decimal form, or not the last one, but the next one up is a standard lot. So these are the three common sizes when it comes to trading. 0.01, 0.1, and a standard lot. You can go anywhere in between from a numerical standpoint, but to keep it simple, I'm just going to use these three. And you can actually go higher than a standard lot. So one pip on a mini lot of 0.01 is 10 cents per pip. A pip on a micro lot is $1 per pip. A pip on a standard lot is $10 a pip. So in an example, if you place the trade and it was plus 20 pips, then with that, you would have either gained $2 on a 0.01 lot size trade, $20 on a 0.1 lot size trade, or $200 on a standard lot size trade. So if you look here, just to give an example of how the markets can move, I'm just scroll down here and I'm going to use this candle here. So every candle, for people who don't know, is every candle represents 1 hour because we're looking at the 1 hour time frame. So every one of these represents 1 hour price data. So if I use this one that I have highlighted here, and I measure it out, look to the right to see how it lines up. So basically the start of this is 1.13, just to round it up. And towards the top of it is around 50 pips. So in this example, 50 pips would basically be $5 on a 0.01 trade, or it would be $50 on a 0.1 trade, or $500 on a standard lot size trade. And this is 1 hour of price data. So reality, in 1 hour on some candles, you could have made either $5, $50, or $500 in 1 hour. So the next question comes to mind is, how much do you need to trade these different lot sizes? And to really answer that question, you have to know what your risk is. So my recommended risk per trade is 2% risk. So if we use an example of 20 pips, that's $2 or $20 or $200. To trade a 0.01 lot size properly with a 20 pip risk, you would need $100 to have those trades. Or if you had a point one lot size trade, you would probably need $1,000, recommended to place that trade. And for a standard lot, you would need $100. I mean, $10,000 to properly trade at that size. So, you don't really need a whole lot of money to start trading. You could actually start gaining money in Forex. And a lot of people would ask, if I have a small account, how does it really grow? When it comes to growing your account, um, just to, getting into the profit side, this video is not financial advice and this is just education. But to grow your account, you want to look at your account in percentages and look at your targets in percentages. And if you could master maybe a few percent a day trading, then you can grow relatively small account to a good amount and let it compound, because compound will take you to a whole nother place. So if you use the example of $200 starting out in a trading account and you averaged around 3% a day. Now, I'm going to be the first one to tell you that you're not going to exactly do 3% every time you trade. You might lose a percentage, you might go down 2%, you might go up 5, 6, 7. But let's just say the average of all of that is around 3% a day. And you trade it for 100 days, which is in business days. So in a month is a roughly 20 business days in a month. And the daily reinvest, meaning that you don't take your money out, which is another hard thing for people to do when they're winning, is 100%, meaning you're not taking your money out of the market. So if you started with that, and then under that scenario, your $200 on today, July 3rd, would be $3,800 by Thanksgiving time. And a lot of people to ask, how is it not this simple? There's two reasons why it's not this simple, and one, it's not this perfect. One, I already mentioned it before, is you're not going to get exactly 3% a day, but if we use that as an average, this is what it would look like on a day-to-day basis. The second reason why a lot of people don't make it to doing this when they have a small account is psychological. So if you're putting in effort to pinpoint a trade in the markets, to pinpoint a certain percentage in the markets every time you trade, you're not going to be very excited about making $6 or $10, or even if we go down $20 in a day. That's not going to excite you a single day's earnings. And you would be tempted to raise your lot size up higher. And what would happen is you would lose your peace when it comes to trading, because you would become more nervous because you're placing a bigger trade than what's recommended. And you may lose, all of your money because you don't have the discipline. But that's a whole nother lesson. But let's say, you go and you do this. You're consistent. You follow your strategy. You're not worried about the necessary profit per day. You know that you have a bigger goal in mind. If you're consistent with it, every day, let's say this is 60 days, 60 business days in, so almost 3 months, you're getting to a point where it's starting to make a little bit more sense, starting to make a little bit more sense. And eventually you'll get to a point to where you'll start liking the returns. If you go another 100 days into it, it'll get bigger. So, you'll eventually start making almost what you put in on a daily basis if you stay patient. You don't take your money out, because if you withdraw, like say you're at 6,000, you withdraw 3,000, well, you got to go back over here. Or you were at 6,000, you withdraw 5,000, well, you're back over here. You're starting over. Now you're back to making $30 a day. But if you leave it in and let it compound, that daily interest can get bigger. And that's how you can trade using the financial exchange markets. And that's how it can become lucrative. You can start doing, what people have been trading for years do, and make, potentially a few hundred to 1,000 a day, depending on the markets, depending on if they trade that day. And just like you can make this, you can lose this too. So it's about having a good risk management and having a good strategy to where you can actually be profitable and have a good winning percentage. Those things come into play when it comes to having an account that's growing. So I just wanted to make this quick video. Hopefully this answered some questions for you. And if you have any further questions, feel free to reach out to me.